Bank Nifty is considered to be much more volatile compared to Nifty, obviously because it is a sectorial index. But one advantage is that it has higher wicks and hence higher premiums. This definitely is an opportunity for option sellers as long as option seller remains within the framework of a specific hedge strategy. Today we are going to share a great Bank Nifty strategy with you, but please watch this video twice so that you are clear about the strategy and its adjustments. I have chosen the worst month for the strategy for backtesting because if we can handle the worst monthly move, other months can be really easy. Welcome to the Option School. This is your friend Pradeep Singla. Let's straightway jump into the strategy and pick up final details of the strategy. What is a ladder strategy? Let us try to understand. Here we will be talking about call ladder. Although here I am explaining for Bank Nifty, but it's quite possible to do it in Nifty also. It's a three-legged option trading strategy. So to make the strategy, you buy one call, sell upper call, and then sell further higher call. So there will be three legs. First two legs, that is buy a call and sell a higher call, creates a bull call spread, which is obviously a bullish trade. Third leg is a call sell, which is a bearish trade. Hence, it's a combination of bullish and bearish trade, which is known as call ladder. Bull call spread is a debit trade, means it will take away some money from the trader, but sell call will give credit. Since all the legs are executed at the same time, there can be overall very little debit or sometimes even a credit is also available. It is always easier to understand the strategy when there is an example. So let me show you an example. After this example, I will also show you a backtesting with adjustment for the worst month for the strategy wherein adjustment was required to be done. So let's see this example. Here we have purchased one call of Bank Nifty, sold higher call, and then sold further higher call of Bank Nifty. This payoff diagram shows that all the calls taken are OTM calls because when you do this trade with all three OTM calls, you make a safer trade on upside. As clearly visible on the payoff diagram also, all the risk is on the upside and hardly any risk on the downside. In the back testing, I will show you all the strikes also so that the trade is 100% clear to you. As we can see in the bottom, the margin required for this trade is 1,69,774. So depending on the volatility, depending on the strikes, the margin can go here and there by few thousand rupees. For selecting the trades, we have two very important insights. First one is for the same amount of debit or credit, OTM option strikes provide much better protection in this strategy compared to in the money or at the money. Second is that the margin required while trading OTM ladders is lesser compared to trading ITM or ATM ladder. So one should take care of both the things while setting up this Bank Nifty option trading strategy. While backtesting the strategy for several months, we found that if the market doesn't move wildly on the upside, there is absolutely no issue in this strategy at all. But for the month of October 2025, market went up very fast, very wildly, making the trade quite challenging. So we said, okay, best way to test the adjustment is let us do a back testing for the month of October. If we can do a back testing for the month of October and bring positive results, I think for all the other months also this strategy can be profitable. So I will do back testing as well as adjustment for October trade. Do click the like button, that really motivates us to create more such content regularly. Thanks in advance. So this is the trade setup as on 1st October 25 at 9:30 a.m. in the morning. Market was around, Bank Nifty index was at around 54,731. So what we have done, we have purchased 56,500 call, which is again far OTM, almost around 2,000 points. Then we have sold one call of 57,500 points above that, and then we have sold another call of 57,500. So overall, all the trade is taken in three OTM calls. One call is purchased, another call is sold, and then far OTM call is also sold. You can see from the payoff diagram, downside is almost risk free, which can be tackled in case market goes down. We can shift the second call sold call down and create some credit. But risk is on the upside if market really goes above this break even point, which is around 57,994. Let us see how the trade shapes up during the month. Nothing much happened for the in the trade for first 15 days. So this screenshot is of 15th October at 3:20. Herein what we are seeing that market has gone up and it has entered into this green zone. So what is the status of this trade as of now? As of now, the trade is giving us a profit of 28.52, which is around 1.5% of whatever is the margin used. One can definitely book that profit, but suppose we want to know the adjustment, we want to see if can I get more profit. So what if we carry this trade till month end? Let us see. On month end, you see, this is 28th October at 3:30. The market went up to 58,271, which has crossed the break-even point of the trade, and the trade is ultimately running into a loss of around 7,600. Now, this is the status of the trade. If we have not booked it on 15th, when we are getting an opportunity to book some 1.57%, and we carry the trade. So, where should we do an adjustment, and what can be the adjustment? Let us see that. Please see the adjustments very carefully. The strength of an option seller lies in knowing how to act when a trade goes wrong. For option seller, market can forgive many mistakes because you know how to tackle your trade. But if you do not know how to tackle your trade and you book your losses, then nothing can be done. Now, this is the status of the trade on 16th October morning 9:30. As of now, we are making profit of around 1,600 rupees on this trade. But two things we need to observe. Market has entered into this green zone, and market has not only crossed our first call of 56,500, it has also crossed our second call, which was a sold call of 57,000. Our third call is 57,500, and market is hovering very close to that. And hence, this is the right time to adjust because my second call, which is 57,500, is a naked call. And if market crosses that 57,500, definitely there will be a problem in the trade because on the upside, there can be unlimited loss. So what kind of adjustment we will do? Let us see that. In the trade, we know we had a bull call spread wherein we had purchased 56,500 and sold 57,000. Now, this bull call spread was made in around 70 rupees or 71 rupees. The trade is now at 360 rupees, 362 rupees. So we are already having a profit of around 294 rupees in this trade. So better is first thing we need to do is book this profit. After booking that profit, only 57,500 sold call will be left in the trade. So what to do with this call? What we will do, we will convert this naked sold call into a calendar spread. Let me show you. Here what we have done, we have purchased a 57,500 call of next series. 57,500 of this series is already sold. So the trade gets converted into a calendar spread. We have already booked first two legs wherein there was a profit of around 300 rupees. Next, what happens? Uh, on 20th of October, 4 to 5 days after that, at morning 9:30, market went up again, but still we are getting a decent profit of around 3,700 rupees, which is obviously more than 2% of the margin. So even after a big move, we are getting a decent profit. But let us say we still remained in the trade. And if we stayed in the trade till 28th October, almost expiry time, the trade is giving us a very decent profit of more than 5%, which is 10,139 rupees. So what has happened is even after a big move of 3,200 points in October, the trade is still profitable. Mainly, the trade is profitable because we have done a very good adjustment. So, already I have shown you what would have happened to the trade without an adjustment and what could have happened to the trade with an adjustment. So, this is not the only kind of adjustment, but one of the best adjustments Only caveat here I will say that okay, you should know how to handle the calendar spread, because once you have converted the trade into a call calendar spread, there is a break-even range. If the trade goes beyond that break-even range, then also you need to know how to adjust this calendar spread. There is a very fine difference between call ladder and call ratio spread. Call ladder is also a kind of ratio spread, but it's not exactly the call ratio spread. Here is a call ratio spread video you should go through to find out best setup for your trading style. Please feel free to write your queries to us in the comment section. You can download the TOS app through a link given in the description. Do like this video and do subscribe to the channel if you have not done it so far.